The RBA just held interest rates at 4.35% this month. That's the same rate it hikes to in May after already hiking 3 times earlier this year, wiping out every single cut from 2025. And yet, Brisbane's median house value is now $1,232,690. Values are up 19.1% over the past 12 months. So let me ask you something. Rates are the highest they've been in years. Borrowing is painful. Consumer confidence is low. And Brisbane house prices are still going up nearly 20% in a single year. How does that happen? And more importantly, what does it mean for you, whether you're trying to buy, already own, or you're stuck renting and wondering if you'll ever get out? That's what we're breaking down today. Stick around because the answer isn't what most people think. And if you're following the property market, Brisbane, Queensland, anywhere in Australia, hit subscribe. We break this stuff down every week with real numbers, not hype.
Let's start with interest rates, because that's what's on everyone's mind right now. The RBA left the cash rate unchanged at 4.35% at its June 2026 meeting. That sounds like a relief after everything that happened earlier in the year, but here's the context most people are missing. The RBA hiked rates 3 times in 2026, taking the cash rate back to 4.35%, erasing every cut from 2025. So that pause in June, it came after a run of increases that undid an entire year of rate relief in just a few months. What does that actually do to a real buyer? 3 hikes in quick succession means a single-income buyer at average wages has lost roughly $36,000 in borrowing power since the start of 2026, and a dual-income couple has lost around $72,000. On an average loan of $736,000, each 25 basis point increase adds roughly $120 a month to repayments. 3 hikes in a row means many borrowers are absorbing an extra $360 per month compared to where they started the year. That's real money out of a real household budget every single month. And what's happening because of it? More buyers are gravitating toward units and townhouses rather than houses, toward the middle ring rather than the inner ring, and toward suburbs with lower price points where their reduced borrowing capacity still gets them access to the market. So rates are squeezing people. They're adjusting. They're buying smaller, buying further out, but they're still buying. And that tells you something important about what's really driving this market.
Here's the thing about Brisbane that makes it different from Sydney or Melbourne right now. The supply problem is so severe that even rising rates can't fully cool it down. Listings in Brisbane are nearly 22% below year-ago levels. There is just not enough to buy. And when there's not enough supply, prices don't fall easily even when borrowing gets more expensive. Why can't more homes be built? Queensland dwelling approvals have been volatile. They spiked 34.2% in November 2025, driven by apartments, then fell 16.3% in December and another 6% in January 2026. The trend is essentially flat, nowhere near what's needed. Builder insolvencies, labour shortages and construction costs continue to throttle the pipeline. Think about that. 1 month up, the next 2 months down. There's no consistent supply pipeline being built. According to BDO analysis, demand for housing in Brisbane is likely to average 16,000 dwellings per annum through the decade. The gap between population growth and dwelling completions is widening, not narrowing. Total dwelling approvals in Queensland also declined by 6.4% month-on-month in March 2026, pointing to ongoing volatility in the construction pipeline. And it gets worse for renters. The rental vacancy rate across Brisbane sat at just 0.8% in April 2026, according to SQM research. A healthy rental market needs vacancy rates somewhere between 2.5% and 3.5%. Annual rent growth hit 6.7%, matching Perth as the highest of any major capital city. So renters are paying more, a lot more. and that's pushing some of them toward buying, even though buying is expensive, because at least then the money is going towards something they own. That's the trap so many people in Brisbane are caught in right now.
Now, here's one number that's actually telling a different story, and most people aren't paying attention to it. The most recent auction clearance rate in Brisbane came in at 48.8%, with 40 properties passed in. That number matters. Anything below 50% means more properties are failing to sell at auction than are succeeding. Buyers are showing up, looking around, and walking away. They're pushing back on what sellers are asking. A result below 50% sits firmly in buyer-favorable territory by long-run benchmarks, and the high number of passed-in results suggests vendors and buyers are struggling to agree on price at the auction stage. It may be the earliest sign that Brisbane's exceptional run of seller-side strength is beginning to soften under the weight of higher borrowing costs and falling consumer confidence. At the same time, open home attendance is declining, and buyer activity is softening. Less competition at inspections, longer decision timelines, more room to negotiate on the right property. Well-priced entry-level stock still moves quickly, around 18 days, but that's breathing room, not a buyer's market. So what we're seeing is a split. The overall price numbers are still going up, but on the ground, the tone has shifted. Buyers have a little more power than they did 6 months ago. Not a lot, but some.
There's one more thing shaking up Brisbane property right now, and it came out of Canberra, not the RBA. The May 2026 federal budget was the most significant shake-up to property taxation in nearly 3 decades. The headline change? From 1 July 2027, negative gearing will be limited to new builds, with changes also made to the capital gains tax discount. For investors who own existing properties, this creates a decision point. Do you hold or do you sell before the rules change? Investors holding for longer rather than selling and triggering a CGT event under new rules could actually keep stock levels tight in desirable suburbs. So ironically, a policy designed to cool investor activity might actually tighten supply even further in the short term, which would push prices up, not down. For first home buyers, there's actually some good news buried in all of this. Analysts are already calling it a silver lining for first home buyers, with less investor competition expected at the entry-level price points where it has been fiercest.
So, let's put this all together. Where is Brisbane right now, and where is it going? Queensland's property market has hit a remarkable milestone, with approximately 99% of suburbs recording growth over the past year. That's not a typo. 99% of suburbs all growing. But the pace is slowing down from where it was. SQM Research revised its Brisbane 2026 growth forecast down to 7 to 11% from an earlier projection of 10 to 15%. Still growth, still strong compared to the rest of Australia, just not the breakneck pace of 2021 and 2022. ANZ Research forecasts Brisbane to grow 9.7% in 2026, one of the strongest performances of any capital city. Meanwhile, Sydney fell 0.9% in May 2026, and Melbourne fell 0.8% in the same period. 2 of Australia's biggest cities are actually going backwards. Brisbane is still going forward, just more carefully. The 2032 Olympics remain the long-term anchor over all of this. The $7.1 billion infrastructure program and construction pipeline will constrain new residential supply right through to 2031, keeping vacancy rates tight and underpinning long-term rental and capital growth. Here's the honest summary. Brisbane's property market is not in crisis. It is not crashing, but it is genuinely harder to navigate than it was 2 or 3 years ago. The easy money has been made. Rates are high. Supply is tight, and the window between what people can borrow and what sellers want to accept is razor thin. For homeowners considering selling, current market conditions still present real opportunities, particularly for properties positioned correctly from the outset. For buyers, quality properties continue attracting significant interest, but affordability pressures mean caution is completely understandable. And for renters, there is no fast solution coming.
not this year. That's the Brisbane standoff in 2026. High rates on one side, zero supply on the other, and everyone, buyers, sellers, renters, investors, waiting to see who blinks first. Everyone's watching what happens next.